Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Woodley.
And you are listening to the internet's favorite podcast about life insurance.
I thought you were just going to say favorite podcast. It's
well,
the internet's favorite podcast.
And I think at this point, we can call it because it's 2026 now. You are listening to the internet's longest running podcast about life insurance. And probably longest by a lot.
Never have two people rehashed so many things so many times.
We're good at that. Yeah. We are good at that. And when we launched the Insurance Pro Blog Podcast, which came after the Financial Procast, which was a little different format.
Yeah.
We said back then, we don't know how long this is going to last.
Yep.
And now the Insurance Pro Blog Podcast by episode count is many multiples of the podcast where we basically just got together and talked about financial news.
Yeah.
And there was even a period when we recorded 3 of those things a week.
Yeah. I think this has been going on for 10 years, something like that. Close to it.
Yeah.
I don't know. Anyway, so we are going to talk about life insurance today, though.
We are going to talk about it. And we're going to talk about the business cycle.
Ooh.
That's exciting. So as you can see in 2026, nothing has changed in terms of our ability to jazz up the episode at the beginning. Still have that very high
people are going
sharp decline of listenership. Happens right around minute 1.
Life insurance. Yep. Not interested in that. Business cycle. Definitely not interested in that. Let's put them together. How can we make it even less appealing?
There is a process. We sit around in a dark office going, okay, that's boring. How do we make it more boring?
Well, now that we've finished up our contract with Sherwin-Williams naming paint colors, we got to do something.
We do.
So the next thing on the list.
So,
yeah. A little different spin today, though.
Yeah, we want to talk about life insurance as it works as a hedge against the business cycle. Mm-hmm. Now, for the uninitiated, the business cycle is the idea that booms and busts are a part of economic life. They're both healthy, and they're just a process of a cyclical motion of how economies grow and then retract and then grow again.
Right. I think you could call it market cycle as well. Business cycle, I guess, at least in economic theory, the business cycle precedes the market cycle. The market is sort of reacting to the business cycle, so to speak.
Okay.
But they tend to mirror one another.
Yeah. Yeah. So the business cycle kind of underpins the whole thing.
Yep.
And the very oversimplified elements here are business does well. Mm-hmm. It continues to pursue the activity that is driving the engine behind prosperity. Unfortunately, everything ends up happening to excess, which has some dangers in terms of inflation. And so there's an effort to blunt that activity and therefore that success, which ultimately leads into, for the most part, a retraction of productivity. And then we fall into a bit of a slump, things correct, and we come back out of it and then begin the process again.
Correct.
From a market standpoint, what this means generally is business goes well, market expands, so stocks prices go up. People are happy. But then we have the symptom of inflation, or the worry about what inflation might create, because inflation is a very destructive force in economies. Yeah. And so we don't want that to go without any sort of shackles. So we try to clamp down the symptom of inflation. And by virtue of doing that, we tend to take the wind out of the sails of business. And we also tend to cause drops in share value for stocks.
Right.
So the lead up to the point of a transition from expanding to contraction has an interesting set of circumstances that are frustrating for the individual investor. But a lot of people who are individual investors find themselves kind of forced into a precarious circumstance because of the functionality of the business cycle. It looks something like this. Things are going well, but you may not necessarily want all of your money sitting in higher risk style assets.
Right.
So you invest in things that are traditionally lower risk, like bonds or cash. And you take the yield from those assets, either for continued growth or for the sake of income, whatever the objective is. But you enjoy the fact that you are collecting something that is consistent, interest, payments on cash, or distributions from debt instruments, whatever the case may be. And
you're probably not that worried about the principal.
Nope, not super worried about principal. You're either going to use that as income or you're going to use that as reinvestment. And things are relatively safe in that world because your risk to principal is pretty low.
Right.
Unfortunately, the move to try to combat some of the uglier aspects of a rapidly expanding economy cause lower interest rate realities, which means what you collect on your cash or cash equivalents starts going down. And as you reinvest in bonds, you're not getting the same yield that you used to have.
Right.
Many, many people find this unfavorable. So what they do to address the circumstance is they tend to wander into higher risk assets that are supposed to have some better return for them in order to make up the shortfall that's coming from this new reality in a broader market from an interest rate perspective.
Yeah. And the thing is, I was probably much older than I should have been because I learned these concepts as a teenager, right? But I was probably much older than I should have been before I actually understood them. Like, to know them intellectually and to feel them are different things entirely. And as I got older, I realized, or more mature, I guess, in my thinking, that these cycles are circular. They feed each other.
Yeah.
So what you're describing is sort of the micro level of how people react, right? But there's sort of I don't know if I want to blame this all on the Fed, because I don't think the Fed is a player in this. But basically what happens is to force so things have contracted, right, to the level you're talking about, interest rates come down. And what happens is it forces people, the underlying, I'm trying to choose my words carefully. The target basically is to force expansion again. And what happens to do that is now people go, well, like we went through from 2009 through 2021-ish. People who normally just bought CDs, as an example, don't feel like they can afford to do that because they're paying 1% for a 5-year CD. And so they're forced into riskier assets to try to get the yield or the return that they're looking for, that they need to have. And so the theory, I guess, is that you force an economic expansion. So that's that side of the cycle.
Yes, from a controlling interest rate perspective, I think the bigger objective would be forcing business activity.
Yeah, absolutely. Yes, from a purely interest rate perspective. I'm sorry, my monitors are going crazy, and I can't hear anything. Hello?
Yep. Can you hear yourself now?
Okay. We'll continue.
Yep.
Yeah. So there's definitely it causes, when the Fed lowers rates in general, in most normal circumstances, it causes business expansion because money's cheaper. So companies can borrow money again.
However,
or feel like they can. They can make things pencil a lot better.
Yes. However, there is this short period where the Fed may be causing interest rates to go down. And retail investors are exiting safer assets, moving into riskier assets because they feel they need to do that in order to make up the loss of return that they're going to experience staying in safer assets.
Correct.
Which does cause an expansion to the stock market because there's more money flowing into stocks. But this little tiny period tends to, in many cases, be the last leg up before a more serious move down.
Mm-hmm.
And it causes a very intriguing psychological panic. Because now we have a short run up in the market that is artificial in many respects, because the Fed's not done doing what it's ultimately going to do to complete the business cycle.
Right.
And so the business cycle kind of trends down, the market trends down, and a bunch of people who were looking for additional yield but are traditionally more conservative investors are now facing their biggest nightmare. They are moving into an asset that is risky, and they knew that from the beginning, and now they are actualizing the losses that they were afraid of from the start.
Right.
And this leads to a substantial amount of panic selling and people locking in losses that they probably wouldn't need to lock in if they just simmered down for a little bit.
Right.
This all starts with their choice in safe asset, because their CDs or their bonds are not giving them the return that they once gave because of the beginning of this entire process.
Right.
There is a way to hedge against this. And you can do that with life insurance.
Show me the problem and I'll show you the life insurance.
There you go. Realistically, though, if you own cash value life insurance, the movement in rate of return for those style products, in terms of a year over year, influenced by broader economic conditions,
mm-hmm.
is much slower than what we experience with most other products.
Right.
If you own CDs, for example, you're going to see a very, very close reaction with market interest rates.
Yeah.
If you own bonds, you're going to see a very close reaction with market interest rates. Well, it doesn't mean that that reaction is going to go in the direction the Fed wants it to go in, but you're going to see a reaction.
Yes.
So
we should have prefaced this by saying this is all like theoretical. It's not theoretical. It's this happens on a spectrum.
Yes.
There's no exact way that it works every single time.
But there is a general trend.
Yeah.
That we see. And so life insurance, because it is slow to move, tends to hedge this problem because there are two things. One, the rate of return of most life insurance products is going to remain relatively stable despite the action that's trying to influence the business cycle. We saw this in 2008.
Yes, we did.
We saw interest rates drop very fast.
Mm-hmm.
We saw whole life insurance dividend rates move rather slowly. We saw universal life insurance.
They didn't move at all for a while, most of them.
We saw universal life insurance move slowly. It moves a little faster than dividend rates do. We saw index universal life insurance really unaffected for a number of years.
Right.
So what that gives the retail investor is a buffer against the reality right here, right now. It stops them from moving into the riskier asset that they're already tenuous about, and then being subject to the risk that the downturn is going to happen because it was going to happen to begin with.
Yep.
And once the momentum of their buying into the market runs out and the decline starts to take place, we potentially stop a little bit of the freak out selling because we don't have near as many people in the market who didn't want to be there to start with.
Right.
So when we use life insurance as both a mathematical but also psychological hedge from this reality, we see pretty good results.
Yeah.
The people who were already in life insurance products at a time like 2008 were relatively unworried about the circumstances. Doesn't mean they didn't worry at all about the assets that they had more subject to the market, but the cash that's in life insurance doesn't move.
Well, I can go back to 2022 and say we didn't get any panic phone calls about what was happening with life insurance policies.
Nor did we see people at that time moving into the market because they felt compelled for whatever reason.
Right.
And even as interest rates went back up, we didn't see movement out of life insurance into interest rates, even though there was an argument for a short period of time that you probably could do better in nominal interest rate return in 1 year buying certain CDs than you were necessarily achieving on some whole life policies.
Right. But that was very short-lived.
It was. And I think this is going to sound a little pretentious, but I think if you're smart enough to get life insurance, whole life insurance, you're probably smart enough to understand the transient nature of interest rates in that period.
Yeah.
That, or you might just be doubtful given the historical reality of interest rates that everybody endured for a decade leading up to that point.
Yeah.
So that's another possibility.
Mm-hmm.
But this is a great way to deal with the loss of return that could be a reality when the business cycle gets to this stage.
Right.
If you are just a conservative-minded individual, so you like to open your accounts periodically and see the number march up, that you just like to see that. You don't want to see it go down. There is a problem that you face when you start to look at values quarter over quarter or however often you look at it, and it goes up, but it's not going up at the same rate that it once was. And now there's some concern about being able to keep pace with certain important things like inflation.
Right.
And that tends to push people into somewhat riskier assets.
Mm-hmm.
There's a very strong case to always be made for segmenting assets.
Yes.
And holding them for very specific reasons.
Yes. I would call that true diversification.
Yeah.
It's not, I think a lot of people understand diversification to mean, I just need to have a lot of things.
Mm-hmm.
It's like, well, yes, but you need to have a lot of things that don't behave the same way.
Correct.
And that's the mistake that we see a lot of people make.
And not all bonds, but we've known for a few decades now that a lot of bonds tend to be correlated with the stock market.
Yeah.
Or at least bond funds.
Mm-hmm.
And so they're not a direct diversification against what happens in the stock market.
Right.
Now, when it comes to the sort of underpinnings of life insurance products from the retail perspective, when we have volatility in the market or when we get through this sort of final phase or near final phases of the business cycle, life insurance tends to be fairly unfazed. At least from what you can tell as a retail individual owning a whole life policy or an index universal life insurance policy. Sure, there is a lot of things that's going on inside the insurance company when it comes to the people managing the assets. They're aware of what's going on, and there are certain concerns or measures they're taking to try and blunt some of the risks that they face at that moment.
Well, they have a lot of levers.
Mm-hmm. But
I mean, they can affect the outcomes in multiple different ways.
Yep. But you as the individual do not necessarily worry or see any of these things unfolding. So when we see sharp declines in interest rates, whole life policies really don't do anything.
Mm-mm.
They just motor on. Index universal life insurance policies, they may see a more rapid reduction in the fixed account for the 5% of people using the fixed account. And they may, when it comes to the decline in the broader market, experience a not so stellar year in terms of the index interest payment. But they don't generally lose money in these cases.
Right.
Any meaningful money. And they're set up for a very, very fantastic rebound, which we've now been able to observe in a number of different instances.
And a rebound from 0 is a whole lot better than a rebound from negative 37.
Mm-hmm. Or even negative 10.
Yeah. Yes.
The data tells us that when we go into a 20% stock market decline, the average time frame for the market to make up that difference, so peak drop back to peak, is roughly 24 months.
Yep.
The average retail investor takes nearly 40 months to recover that scenario.
That points to some behavioral issues.
Yeah. Because there are decisions made in the moment that are all totally understandable, by the way. Like, everybody says, this time it's different.
Yeah.
And there's a little bit of truth to that, but for the most part, it's not. And every major decline is followed by an expansion that gets us back to where we were before. Then we go even higher.
Yes.
But what if that doesn't work out this time?
Right.
This is real money that is going to significantly lay out the choices someone can make in the future with their lives.
Mm-hmm.
It is understandable that they would be worried about protecting it and then preserving what's left after a big drawdown.
Yep. And the beauty of life insurance is it gives you the power to wait.
Yes.
When you have some money that's not subject to the whims of the business cycle, as it were, then you have a resource that you can use in the meantime, so to speak.
Mm-hmm.
And so if you believe, as most people espouse, at least verbally, well, things are going to normalize and come back around. Okay, well, you just have to sit tight until that happens. But it's really bad if everything you got is subject to that cycle. So,
yep. And there are two different stages in life where this can happen.
Mm-hmm.
And the first...
And hedges are never exciting. It doesn't matter.
No.
I mean, even in a hedge fund, the hedging part is... Generally speaking, the hedging part of any fund that I've ever seen is it's this portion of money that just seems to always lose until it doesn't.
Yep.
And that's kind of what it's there for.
Mm-hmm. This is very true.
There is some opportunity cost involved in that, obviously, but
yeah. Well, it follows the same intuitiveness of, if I put some money in less risky assets, I know I won't lose money, but I know I also won't gain when the market rallies.
Right.
The same concept is happening in all hedging activity.
Yep.
And in truth, conservative savings of some degree is on its own a hedging activity.
Right.
It's ensuring that there is some degree of money that you have, regardless of what happens broader market-wise. Now, there are all kinds of additional, highly sophisticated ways that you can try to hedge. The key trick there is that you actually have to execute them correctly, because if you don't, then they don't really work as hedges anymore.
The devil's in the details there.
Mm-hmm.
Yeah.
But they do exist, and people
life insurance is a very simple way to do it.
It is a very simple way to do it with a very fantastic rate of return as well for an appropriately profiled risk.
Yes.
It is not going to take off like NVIDIA. It is not going to perform like silver as of late.
Right.
It is going to be much, much, much more comparable to money market funds or kind of intermediate bond funds.
Yep.
But it provides those rate of returns, or good rate of returns relative to those things, with intense liquidity.
Mm-hmm.
Liquidity that you have, which is...
And very stable principal.
Yep. Which is a very, very strong feature, especially in a bad economic moment.
Sure.
Now, I mentioned earlier, there are kind of two phases that you'll be facing here. One is when you're just saving money. You're still working, you're not retired. It's a lot easier to stay the course in those moments. The other phase is when you are retired and you're relying on the assets for income.
Yeah.
And I speak from a lot of experience working with people, knowing that there is considerable more worry among that crowd when market declines happen.
Yeah.
But oddly, they are just as susceptible to marching kind of to their death at the end of the business cycle, trying to buy into higher returning assets because what they were getting is not what they're getting now. And that's not working. So we got to do something because we're missing out on things.
Right. They're adjusting the wrong thing.
Yep.
Instead of adjusting their expectation,
yep,
they're chasing that expectation.
Yep. And they chase into the market at the exact wrong moment because the business cycle is setting
or whatever.
Up.
I mean, whatever they decide to do. Yeah.
Yep. A lot of times though, it's the market.
Yeah.
Then the decline happens, and this effort to capitalize on making more money turns into, well, now I have less.
Right.
Which is a big problem because for most people, I already wasn't in a position where I had more than I knew what to do with.
Right.
So now I have even less.
Yes.
And that becomes a frightening moment that is completely avoidable with various life insurance products. When it comes to life insurance itself, whole life insurance and index universal life insurance, the income that is capable from those things is pretty unfazed when we go into various business cycle moments.
Yeah.
Again, dividends, they don't fluctuate that quickly. And even index universal life insurance doesn't move around over a long enough period of years to cause any major concern. So if you've got a policy that you're using for income purposes and there's a big market crash, whole life insurance is going to be almost undetectable. Index universal life insurance, you may have a year where you have the lowest possible interest earnings.
Right.
But generally it's that year. Yeah. And then you move on. That doesn't upset the income capabilities at all.
Mm-hmm.
Annuities are another option that are completely oblivious to market cycles because the guaranteed income feature of an annuity is totally untied to any sort of account balance in the annuity.
Right. Exactly.
So
it's an actuarial calculation.
Mm-hmm. These are strategies that you can employ to keep away from the sort of tail wagging the dog aspect of the business cycle that a lot, and we're speaking from experience here, a lot of people run into.
Not to get too basic on insurance speak, but you're transferring risk. That's what insurance exists for.
Mm-hmm.
The risk doesn't go away. It's just that the insurance company is absorbing it.
Yes.
And they're really good at that.
They got a lot more money than you do.
They got a lot more money. And they've been doing that for a very long time.
Mm-hmm.
That's their whole business. So,
yes. And it, I think some people think very, very, very elementary in the sense of, well, they transfer the risk of death. But yes, but they transfer a lot of market risk elements as well.
Yeah.
And they've been doing it for a long time. And they know how to deal with it.
Which is the only way they can insure your death. It's because they're really good at that part.
Yeah. So if you're looking for an asset that can help break the cycle of being kind of whipped around by the business cycle and gives you a better hedge because it is, I think, as close to immune from the realities of economic circumstances throughout the various elements of the business cycle, life insurance products are definitely things that should be looked at.
Yeah. They should be a portion.
Mm-hmm. A portion.
Yes.
Operative term there.
Yes.
This isn't 100%.
We're not 100%ers.
No. No, we are not.
But yeah, you should definitely consider it. That's for sure.
Mm-hmm. Okay. Any final thoughts?
No.
Okay.
I'm good.
Then I am Brandon Roberts.
And I am Brantley Whitley.
We're so happy to see you in 2026 again, and we will see you again next week.